So sorry, we're a little bit late. We're 1 minute late. Michael was in a rage about the latest personnel issues at the New York Giants football organization, and Duncan was like dicking around doing. I don't know. The whole thing is inexcusable, quite frankly. And we're gonna have a team meeting when the show is over. Francisco Scaramanga, welcome back. We see you. Tom Whalen, what's happening? Anthony Chavez, I see so many red pandas. Love you guys. Had a lot of fun with Ian and the gang last night on Earn Your Leisure. If you haven't caught it, it was honestly a lot of fun, and we got to a lot of stuff. Cliff Peoples, what's happening? Chris Pinati, C. Marie, Jay Luther, what's up? You're crazy. All right, everybody's here. Listen, this is gonna be a big show. We have a lot to get to, but before we do, quick shout out to Y Charts, best sponsor in the world. Galaxy, those of you who are doing any kind of research on stocks, bonds, the economy, ETFs, and you haven't given Y Charts a spin, by all means, use the link right below us, and you'll get a discounted first trial of the service, and I think you'll fall in love with it. So shout out to Y Charts. Thank you so much for sponsoring the show. Okay, number one, today and yesterday was kind of like one of the biggest 1 or 2 day comebacks for tech that we've seen yet, just percentage wise, and like it was like very dramatic.
Hold
but
on. When you say yet, you mean like in the recent yet, not in history, like in the recent crash,
like a 24 to 36 hour turnaround. I'm saying,
okay.
But it seems like the theme of this year is anything but tech. Like when you look at what's been working, staples, healthcare, energy, financials.
11 days in, we already got themes for the year.
Yeah, we have a theme for the year. Life moves quick, right? Risk doesn't wait. Risk doesn't wait for you to get your act together.
You could say that risk doesn't sleep.
Risk doesn't sleep.
Some people have said that.
Yeah, those are the worst people that we know. So here's what I want to do. Here. First things first. Why am I saying that it looks like the trade is anything but tech? This is late last week. It looks like roughly 4 in every 10 companies on the Nasdaq Composite, which is everything on the Nasdaq, have already seen their market values cut in half from 52-week highs. The majority of names in the Nasdaq Composite are in a bear market of their own, meaning down at least 20%. And a lot of these stocks made their highs last February. So it's almost a year of declining stock prices in some cases. Do I have that right?
You have that mostly right. The ones that are down like 80% peaked in February. The ones that are down 30, 40, Shop Square,
September.
Those peaked more recently. Shop just peaked in November. But let's start this chart. Give Sentiment Trader some love. So what this chart is showing is the Nasdaq Composite up top in the black, and below you have the percentage of stocks that are cut in half from the 52-week high. And it's remarkable where we are, again, 40%, given that the composite is fell 6% peak to trough?
It's really crazy, the disparity between the gigantic mega cap NASDAQ stocks and almost everything else in the index. Mm-hmm. Like for me, that's become more pronounced as stocks are falling than it was on the way up. But now you've had this huge reversal. Hold on one sec. You've had this huge
4% off the lows from yesterday for the Qs.
There are some names, though, that are up like 10 or 15%, like really, really quickly. And they should be because they were down 30 and 40%. Right. But I agree. There's still too much technical damage to be like, okay, that was scary. Right. I really don't think this is over yet. And I don't know how deep in I would say we are. But if I had to guess, I would say like 4th or 5th inning, not 7th or 8th. What do you think?
I think it's hard to make like it really depends what you're talking about. Like that could have been it for Apple. That could have been the bottom for Apple. But the Zillows of the world, the Pelotons of the world.
How far off did Apple come from its high at the worst point? 4%?
Yeah, not much.
Barely.
But stocks that go down 70, 80% don't just go straight back up. Usually it's like you could get like vicious bounces, but then you're going to have like rollovers and just all sorts of slop as it tries to find the bottom. We might be there already. We might be there for a few of these names.
Okay.
Peloton looks like it's trying to bottom. Zillow just made a higher low, but we'll see.
If you're getting 3 rate hikes And now Jan Hatzius at Goldman is talking about 4. And I see there's a not 0% chance based on futures markets of 5. By
Eddie
the way,
Eddie Elfenbein, of course,
I don't even think
Wall
there'll be
Street
2.
is talking about 5.
I think there's going to be 2, and then financial conditions are going to tighten so much that they're going to stop. That's my personal opinion. So it ain't going to be 5. I think they're going to do 2 rate hikes to get off of 0, and then focus on balance sheet reduction. That's my bet, and we're going to talk about that later. But even if you think the truth is somewhere in between 2 and 5, it really does make it tougher to own a stock that's selling at 60 times revenue. Even if that company is growing revenue by 40, 50%, it's still very, very hard to conceptualize why you own a stock at a valuation like that. And that's why they don't just rebound back to all-time highs. They can bottom. They even can bounce. The bounce can stick. It's going to be very, very tough to see an environment like January, February of 2021 for a long time if we're actually in a higher rate cycle.
Listen,
what do you think about that take?
I agree. I'm in some of these names for a trade, but if they roll over, I'm out. Like I am not fooling myself that this is the bottom. Putting out little feelers.
I got stopped out of Coinbase at like a 10% loss.
Come back in.
I blew out Robinhood.
Come back.
No,
I'm not
ready. I'm not ready. I don't feel comfortable, Michael. I've been burned too badly.
Come back.
I've been burned too badly.
Revenge trade. All right, let's move on. So we're gonna stick with this theme. So history is rhyming, right? There's no doubt about it. I want to talk about the latter part of that statement, but it doesn't repeat. People always forget that part. It doesn't repeat, and I think people are too eager to see that part play out. But Corey Wang did this amazing tweet thread. I wrote about this today, talking about lessons from the tech bubble. And is it possible to zoom in on this chart? It's a bit unclear. There we go. Oh, beautiful work, John. Thank you. So this chart is from the dot-com bubble. It shows the trailing PE ratio, and that's the black line. And then the new economy names the Amazons of the world, Qualcomm, the hot stocks back in the late 90s in gray, the new line, right? And these were trading at nosebleed valuations. And clearly, we are seeing a lot of those same dynamics today. The disruptors of the world, and they've come back to earth, right? Zoom, Teladoc, we don't need to relitigate that. But Michael Ararette shared a chart that I don't think is deliberately misleading, but I just wanted to provide some context with this because I think it's important. Next chart, please, gentlemen. We're seeing the market cap from the late 90s to today in red. I'm sorry, the market cap, right, okay. We're looking at companies that have a price to sales ratio of more than 20.
The market cap of highly valued growth stocks. That's what
Correct.
This is.
Correct.
Okay. Red is when?
Companies that were trading for more than 20 years.
Okay, got it.
So, for example, like Apple is in red, right?
So Apple's selling it over, but Apple is a price to sales ratio of 20?
I'm sorry, not Apple. What am I talking about?
I don't think so. You're thinking like Adobe.
NVIDIA.
Probably.
Is NVIDIA? Yeah, okay. But the point is that the market, so you're seeing like the market cap. Oh my God, look at the blue line compared to, this makes the dot-com bubble look small. Well, not really.
Right, but it's newer companies.
Not really, because the market is 3.5 times bigger today than it was back then. So you really do have to adjust for market cap, with which Jeremy Schwartz did. So let's look at this next chart. This shows the percentage of U.S. stocks with a price to sales ratio over 20. And that's really high. 20 is really high. So it's only, and I say only, it's 8% of the index, which again is still, I'm not saying stocks are cheap by any stretch of the imagination, but it's half of what it was in terms of the overall representation of the market, where it gets close.
Mike, it's 8% of the companies or it's 8% of the market cap?
The market cap. Where it gets close is next chart. The number of stocks.
Or percentage of stocks, it says.
The number of stocks, not the weight, the number of stocks. So we have a lot of stocks that are trading above a price to sales ratio of 20.
Okay. So now think about the major difference. One of them is that a 10-year treasury, while that shit was going on in 1999, was between 6 and 7.5%. Mm-hmm. And right now it's 0. What is it, 1.7? On an inflation-adjusted basis, you actually lose money on a 10-year treasury. So why wouldn't we have stocks selling at higher valuations in general? People require a return to come from somewhere. You may lose money in a stock, but at least you have a shot to make money. You are guaranteed to lose money on an inflation-adjusted basis in most fixed income. So that's a major difference that should be brought up every single time we do anything comparable to the 90s and today.
The other big difference is that Corey Wang points out that this was not just a tech bubble, it was a large cap growth bubble. So you had stocks like Walmart was trading at 46 times earnings. Coca-Cola was trading at 43 times earnings. Ludicrous shit was going on. Pfizer, 92 times earnings. So I guess the point I'm trying to make is like the post-dot-com bubble were the glory years for value, for smart beta. If you were doing anything other than growth investing, you look like a genius. But after the dot-com bubble burst, Nasdaq lost, what did it lose? 80-something%? Some of these names lost 95%?
Yeah, well, there were a lot of zeros too. So the 85% was like if you were lucky. That's not going to happen this time.
Another part of it rhyming this time is that, and it's still we're still very early into this, is that growth stock resurgence. Buffett's back on top. You see a ratio chart of Buffett to ARK?
Yeah. Yeah. Oh, yeah. And he doesn't get it. He doesn't get metaverse. He doesn't get Bitcoin, et cetera, et cetera. But, this is like, it's almost, so a lot of aspects of this is like watching history repeated, because you can Google and find the articles of Buffett being ridiculed for not understanding the internet in 98 and 99. And by 2001, he became the last man standing. Like 01, 02 was a huge resurgence for Berkshire Hathaway. So might that be the case in 22? Maybe. The stock is one of the best stocks in the S&P 500 this year. It clearly broke out above 300, which we had been talking about on the show. And it has everything you could want in this environment. It has tons of cash to take advantage of opportunities. Let's say it wants to buy Peloton. Tons of real estate exposure. Tons of industrial exposure. The railroad, which is charging record rates for moving goods and products across the
Peloton fits
continent.
nicely. It's almost like a utility at this point. It is for me.
Yeah, right. Peloton's just like See's Candy. It makes perfect sense. But the point is, they have the financial exposure. They have like tons of cash, so that kind of optionality, and they have the railroad and the utilities from two very hot sectors, like energy, utilities. Like this is kind of like the type of stock that should be working this year, and it very much is.
So here's what I'm interested in.
I thought that was interesting.
So ARK fell about 50% peak to trough. But like the
ARK is the anti-Buffett.
Yeah, the Zooms of the world, like. Zoom is down, 70%. Like, do these things fall another 40%? Because that would be like tech bubble territory. Do these things fall another 40, 50%?
I think I think some of them can. I don't in particular think that like the whole index is going to do that, because the cash flows are just too enormous in the Nasdaq 100.
Zoom is still a $50 billion market cap.
Do this thought exercise with me. Look at each one of those names, and ask yourself, if the company disappeared, would it really affect anyone?
Well, Zoom, absolutely.
How?
What do you mean how?
I did 3 meetings this week on Google Meet.
Google Meet, yeah.
What's the difference? Who gives a shit?
All right.
So, I mean, I hate to say it that way, but it really is that way in that particular case.
Okay, fine. Teladoc?
Do you understand that every insurance company is working on their own Teladoc?
DocuSign?
There's 3 of those too. By the way, Adobe has a faster growth rate for their document signature, whatever it's called, than DocuSign.
Anyway,
DocuSign.
No, that's not a good thought exercise, because that's what its investing is about. If this company disappeared, would you notice?
No, but you're asking, could they fall 40%? That's how I tell you that they can.
Of course they could. Of course they could.
Right, but do the same thought exercise. Could Amazon Web Services disappear tomorrow?
Dude,
no.
Amazon, well, that's why it's a $2 trillion market. It's very different.
So that's my point. This is the difference between a stock that could fall 10% and a stock that could theoretically fall 80%. This is the difference. Is there another company that's ready to step into the breach and do all that business? Because that's how investors think about it. When they watch a stock, when you own a stock like Zoom, and you watch 2/3 of the market cap get sucked out of this thing, You know what you're saying to yourself the whole way down? Why do I own this? Why do I own this? Why do I own this? And then eventually, I can't own this anymore. So that's how a stock falls 80%. I'm not saying it deserves to, but as they said in The Unforgiven, deserve ain't got nothing to do with it.
Zoom deserved to. I think I don't want to misquote, but their revenue growth slowed dramatically.
Did you see DocuSign's results?
And if you're trading
2 weeks ago,
if you're trading at 120 times sales, sorry, like double-digit earnings growth on the low end, like 10 to 20% is not nearly enough.
The more interesting question is, the longer this goes on, what are the ramifications for the private startup market? No. And does Stripe just say, forget it, we'll wait? Does SpaceX want to come out in this environment? Does ByteDance want to come out?
It depends how long this goes on.
I mean, I can't come up with a reason why all of a sudden a stock that's gone from selling at 50 times sales to 30 times sales, as much damage as that means, is going to be 40 times sales again. It's impossible for me to imagine. So I'm not saying it can't happen. I'm just saying if you're in one of these stocks and you haven't had that much damage and you don't really even want to be in it anymore, like it might not be the worst idea to take a loss and look for something that you can make the money back in. You don't have to make the money back in the thing that you bought. There are other ways to do this than praying. No, you maybe spiritually you feel the need to win back money in the same game that you lost it in.
I'm only teasing. I spent way too much money, time, and aggravation revenge trading. I'm only kidding,
dude. When I blew out of Robinhood at basically a break even and got stopped at a Coinbase at a loss, it was amazing. I was like, thank God, because I wasn't gonna pull the trigger on that Coinbase loss.
Bottom.
No, I can't wait to redeploy anywhere but there.
Hold on, let's just before we move on, I do think that a lot of this is riding on the 10-year. Like, I think that if rates remain firm or even go higher, these trades are going to continue to go lower.
If the 10-year doesn't fall back to 1%, meaning?
Oh, it's not going to. I mean, 1% is dramatically lower. We're at 1.55. It was as high as 1.65. I think if we remain up at these levels, I think it's going to be tough for these names to meaningfully bounce. We'll see.
Yeah, I agree. And you could say, well, it shouldn't be that way. Fine. But that seems to be a very, very rock solid correlation right now. So I think you're exactly right. All right, let's go. Do we miss any charts here? Or are we going next?
No, we're good.
We're going next. All right. How do you place an interest rate bet? All right, so I want to clear the decks here, and we have to do a disclosure of something before we get into how we want to approach this topic. But there's basically two ways currently that most people would place an interest rate bet. The first way is they know how to trade futures, and they'll be on the CME, and they will literally buy or sell the contracts. Professionals. I don't think a lot of retail people are doing that. The second way is to find stocks that go up when rates are cut, or vice versa. When rates go up, what stocks will go higher.
Well, there's also ETFs. There's also ETFs like TBT.
Yeah, and they'll try to express that trade in the stock market, either with ETF or a stock. There's a new way to bet on rates, and I'm going to let Michael do the quick disclosure, and then we'll explain what we're talking about.
So Ben and I had Tara from Kalshi on Animal Spirits a couple of months ago, and we were so blown away by the potential of this platform. If I wanted to bet on the real estate market, like the Case-Shiller index, there's not an index that you could invest in, right? I can't bet on national home prices rising 8%. I could buy Toll Brothers. I don't want to buy Toll Brothers. If I want to make a bet on the interest rate on the real estate market, I want to do that directly. So we had Tarek on the podcast. We've been talking to them for months.
It's called Kalshi, and the website's kalshi.com, KALSHI.
Here we go. So you could trade. So they're regulated by the CFTC. You can make bets on all of these different things, and so we've joined them as advisors and shareholders, which we're super excited about. So that is a disclosure. So let's get into what we're doing.
We own stock in Kalshi, everybody. That's the disclosure. All right. So I have a couple of interest rate bets on personally on using that site, and I'll be doing more, and Michael too. How do you want to set this up? What we're actually betting on?
So let's talk about where these probabilities come from. So professional traders bet all the time on the Fed funds rate. They bet on the futures market. And the CME calculates the probability of different rate hikes or of different interest rate regimes based on where the money is going. So if we look at March, for example, throw this up. It shows you where the market is expected to be. And here's what's really interesting about this. So what this is showing is that there's a 77% or 78% probability based on where money is positioned for a rate hike in March. Right now we're at 0 to 25, the bound on Fed fund futures, on Fed funds rate. People are betting that it's going to be from 25 to 50, meaning one rate hike. But here's what's interesting, and here's what really put a monkey wrench into the market last week. So 1 month ago, only 33%, there was only a 33% probability, again, based on these metrics, that there would be a rate hike come March. Only a 33% chance.
The metrics is just people placing bets in the futures market.
Yeah, so I think
that's the consensus, like, guess of the crowd based on what contracts they're buying and selling. That's how we come up with the market's expectations for when.
So the CME group lists 30-day federal funds futures, prices of which incorporate market expectations of average daily Fed funds rate.
Right.
All right, that's pretty much the long and the short of it. So a month ago, 64%, there was a 64% probability that it was going to remain at zero. That dropped to 17% today.
Meaning everyone knows there's going to be a rate hike.
So
now.
Basically, everyone thinks that they're going to go, and this is reflected on Kalshi's contract. So I, like an a-hole, I missed the boat, and we'll get into this right now. Throw up this first chart. So the green line is showing like where the market is and where it's come from. So today, if you wanted to bet on this, yes is 84 cents, no is 16 cents. So I went to put this trade on today, but I missed it. If I bet $100, I would only make $17 because why? It's already priced into the market. I missed it, and I'm not going to do no. Because even though that you get great odds there, it's a sucker's bet. It's because they are going to go.
So, all right. So on Kalshi.com, rather than try to figure out which bank stock would go up when they raise rates or get the timing right or try to do futures trading, which most people aren't cut out to do, you can simply say, I want to bet yes, that the Fed funds rate will be higher than 25 basis points in March, meaning there'll be one hike. And you buy the contracts that are saying yes, and you have to pay a certain amount of cents per contract.
Yes.
So in this case right now, you have to put up a lot more money than you're going to make that bet because the market is already there. You missed out on it. It would be like I want to bet like Jake Paul is going to have a boxing match with Michael Batnick. Where would the yeses be? Probably 99 cents.
Exactly.
And the no's would be 1 cent. It would be very obvious that you're going to get knocked the fuck out.
So it's pretty much a slam dunk of Ruski that they're going
right.
to raise. Obviously, there's no free lunch in any market. That's reflected in this market. But so I looked out to June. I said, all right, what is it going to be in June? Unfortunately for me, I missed this one as well. Even if I wanted to put like $500 on here, I'm only going to make $80 because yes is at 76 cents. And there's no juice there. I can't do that. And I'm also not that gutsy to take the other side of that. What I wanted to do was maybe place the under for 4 rate hikes, but they don't have that because it's important to mention this is still very much a new product. If you wanted to drop like right now we're playing, this is fun. If you wanted to do a serious bet here and put $10,000 on this, the market, it's just not there yet.
There's not enough users. There's not enough volume of people saying yes and no on both sides of the trade. There's not enough liquidity to put real money, but that's changing as more people create accounts. So my bets are, I think after the June meeting, there will have been 2 rate hikes. I think I'll nail that, and I have the March bet also. I don't have a lot of money in either one, but I bought as much as I could.
When did you get in? Like, because right now it's
like in the last few days. I'm already up in both of those. Now
so
I
missed it.
Now I lost money in a totally different bet, and we're not gonna spend any more time on this tonight. But I lost money in an Omicron bet before the end of the year. I said Omicron would be less than 40% of all cases by the end of February. LOL. It's probably going to be 110%. But anyway, this is a lot of fun, and we're just learning the platform ourselves. And obviously, just a quick disclaimer before we move on, nobody should be on there placing trades with money that they can't afford to lose. It's betting. It's not an investment, and conduct yourself accordingly. And don't think that this is anything other than speculation at this point, and just be smart about it. Right?
Okay.
Is that
Great
fair?
disclosure. Yes.
All right.
Okay.
Shout to Kalshi.
Okay. Let's talk about venture. Andreessen just raised. They're announcing that they're raising $9 billion. It's a $1.5 billion in a bio fund, $5 billion in growth, $2.5 billion venture. So they said, coupled with the $2.2 billion crypto fund and the $400 million seed fund we raised in 21, we will continue to invest across the entire spectrum of stages. There is so much money ready to be deployed that I think it's going to take a while for the ripple effects. Assuming that growth continues to compress the multiples, I think it's going to take a while for that to hit private markets.
This is such a good point. This is such a good point. And the reason why is, let's say all of a sudden there's this huge growth scare and rates fly up higher and stocks get killed. All of these firms that have raised these massive funds, they're not going to be like, oh yeah, you're right, I surrender. Here's all the money back. So they're deploying almost no matter what. It's very unlikely that A16Z will become bearish on Web3 just because the Fed raises rates to 2.5%. So I totally agree with you. It will be a while for that feedback loop. That being said, I think venture investors are going to be able to get into rounds at lower valuations because the companies will have less options to raise money, and they'll have to accept the fact that not every company is worth $1 billion just because they created a logo on Photoshop. Is that fair?
It depends how long this lasts.
Okay, but two guys and an LLC is not $1 billion anymore, and I think it was 6 months ago.
It depends how long this lasts.
Okay.
All right, so let's talk about frothy funding markets. Let's throw up this chart.
Is this Packy?
This is Packy. So,
okay.
But here's the thing. So this chart is not actually showing funding markets. It's actually showing exits. Exits.
So what is it? What does this mean?
Let me read Packy. Total exit value. And when we say exit, we mean either a public exit or M&A. Total exit value grew 168% from the previous best year ever in 2020 to $774 billion. And Stripe, ByteDance, which is TikTok, and SpaceX haven't even IPO'd yet.
Right.
And here's one more amazing thing. So we talk about how crazy everything is. The 2.3 time exit to value ratio, meaning it's exits to how much funding is going on, is the highest in any year since 2006, except for the 2012, the year that Facebook went public. Meaning investors and employees are pulling more money out than they put in by the second widest margin error. So there is a reason venture capital investors are not completely stupid and haven't lost their minds. Companies are able to get to scale so much quicker and at such bigger numbers today than they have back then. Now, obviously there's a limit, right? We might go over the edge where we start paying too much, but we're not there yet.
I think it's fascinating that nobody seems to understand that all this is the taxpayer underwriting Silicon Valley. How does everyone not just intuitively understand that the reason why these founders and early investors are pulling out so much money in these exits is because the Fed's balance sheet is $9 trillion. Why does it have to be more complicated than that? We invented money out of thin air. The Fed is monetizing the debt. There's so much capital, too much capital, and most of where you can see that capital in real life ending up is in funds that are basically giving entrepreneurs money. I'm not saying they shouldn't. I'm not saying I don't like it. I'm just saying it's not mysticism. It's so fucking obvious what's going on. And if you were in the way of that money, if you were positioned for that train to roll right through your backyard, congratulations. But that's what's going on. These massive exits that people are getting, I put in $10 million and it's worth $6 billion. That's the Federal Reserve giving you money because you took risk and backed a great founder. And it's great. It's great. But it shouldn't be that complicated to people that's going to slow down now.
Okay, fine,
it just shouldn't.
That's not controversial. I agree with a lot of what you said, but the counter would be like, so if easy money becomes a little bit less easy, does this all reverse? Because I don't think it does.
It doesn't have to reverse. It can slow down. This is one of the things that I always talk about, where everybody assumes everything has to end with a bang, when in fact, most things end with a whimper. We talked about like the SPAC market.
Well, that ended with a bang.
No, it didn't. That's the thing. It took a fucking year, and it went from the average SPAC selling at 20% premium to cash to now the average SPAC selling at a 5 to 15% discount to its cash, but it was glacial. There wasn't one moment where every SPAC blew up.
That's true.
It just was this grind.
I guess I'm calling that a reverse bang. Are you calling that a whimper? Are we saying the same thing?
Everybody can get banged as far as I'm concerned. All I'm saying is there's not this definitive moment where we say, oh,
that's true.
That's it for venture, or, oh, that's the last IPO. It never ends that way. It's not a storybook. Okay. And people are always looking for that moment that never appears. Yes. I want to shout out a couple of people real quick here who are making me laugh while I'm talking. Bobo Meister 74 said, "Can't believe Josh is still standing. What an athlete." I agree.
How do they know you're standing?
I don't know. Michael built this desk for me this morning. Our friend Rachel, I'm crying a little thinking of AC. No, what did she say that was funny than that? Two Guys in an LLC would be a great TV show or something. All right. A lot of shout outs to the standing desk. I appreciate that. All right.
Wait, hold on. One more thing I wanted to discuss. This is just kind of ironic, I guess is the right word here. So Citadel Securities today raised more than $1 billion. I don't know why Ken Griffin couldn't just sell the Constitution and fund it himself, but at a $22 billion valuation, and here's the irony. So Weisenthal writes, it's a real role reversal from what we're used to seeing. Normally, it's a traditional finance firm backing some crypto upstart. This time, there's the crypto native firm investing in an established institution whose primary area is legacy markets.
Did you read Matt Levine on this?
No, what did he say?
Oh my God. Basically.
Don't basically. Give me the quote. I want the quote.
No, the money quote. I'm pulling it up. But Matt's take was like, yes, Ken Griffin has spoken negatively about Bitcoin before.
Hold on. Let me just give you time to find this, because I feel like most people can be paraphrased. I feel like Matt Levine deserves some respect. You quote that man.
The piece was who can resist the crypto boom? And basically he pretends it's a conversation. Paradigm says, we are a leading investor in crypto trading firms. Citadel says, well, don't look at us. We hate crypto. Never traded it, never will. Paradigm says, I suppose we could use some diversification. So basically they're buying into a firm that's mostly trading stocks. So now what does Citadel get out of this? Basically, they're getting huge money, and if in fact they do have to make this move over to crypto,
it's going to rake.
Yeah.
Oh my God.
All right, here's the quote. Matt Levine, Bloomberg. Meanwhile, Ken Griffin, founder of Citadel Securities, is worth $21.1 billion, which is pretty good, but he's been doing it a lot longer than these other guys, meaning the crypto guys. Being a stock trading middleman was a good way to make a fortune back when stock trading was dominated by a few big inefficient banks. Now it's okay. It's efficient and grueling, and you fight for every basis point. And you also have to be the subject of congressional hearings and weird conspiracies. Meanwhile, in crypto, people will pay millions of dollars for a JPEG of an ape and then hand over the private key to anyone who asks nicely, Michael. In crypto,
too soon.
You can make huge profits by being a robot counterparty for fat finger trades. No one will break those trades. And the typical transaction fee for a $75 transaction is $75. So basically, it's a honeypot, and it's impossible to resist. If you're in that business of being a middleman and being in the middle of trading, this is literally the most profitable trading you could sit in the middle of in history.
They're gonna make so much money. It's ridiculous. Ridiculous. How much they're gonna make.
Yeah, the take rate for exchanges is 0.57% of their transaction volume versus a nano penny. Right. So Ken Griffin is looking at Robinhood making 0.5% on every crypto trade and saying, "Wait, how are we not here?"
Right.
So he doesn't have to believe in it. It's just that's where all the money's being made.
All right.
So I thought that was interesting.
What do you got next?
I was gonna do this thing on Decentraland, and we could do this quickly.
Okay.
I read this whole thing at the Generalist, and Mario is awesome, and it's really well done. And I had this epiphany. So he's talking about Decentraland basically being the start of the true metaverse that's not owned by a corporation, although it kind of is, but whatever. I had this epiphany. I'm like 9,000 words into this piece, right? And you know how people are always like, do the work? Like, did you do the work? You need to do the work. This is my recommendation to you. Don't do any fucking work on this, because you would have to quit your job and spend 18 hours a day living in this world amongst these people, these Argentinians who live somewhere called Voltaire House in Buenos Aires and are walking around literally with masks on and all kinds of like daily activity as things change. You will never, ever be able to have an edge in this market unless you fully commit your whole life to it. And I really don't think that anyone should do that. So do what I do, read all the things, listen to the podcasts, and then just buy a crypto index fund. And understand that if Mana, which is the currency for Decentraland, really becomes important, it will become important in the index that you own, and you will be just fine. You don't have to outsmart the market. You will never be able to. Don't do the work. Is that bad advice?
No.
You guys good advice? Would you say that to somebody?
Generally speaking, for our audience, that's great advice.
Would you say that to anybody over the age of 25 who has aspirations to like get a job, get married, have kids?
Well,
like,
if you
don't
want,
do any work on this?
If you're not working in crypto and it's not your passion, I would say...
What chance do you have? None.
Yeah,
you have no chance.
Yeah.
These
Generally
these
speaking,
people
that's good
live
advice.
in the metaverse.
Right.
So you're going to write about it from a distance with a straight face and try to come up with insights that they haven't thought of?
It's hard to dabble. It's too complicated. We were talking, I did a podcast with Larry from The Block, and they have 65 analysts, and he was saying it's overwhelming. They can't keep up with everything. It's moving too quickly. It's dizzying. So yeah, I agree. Indexing crypto is a very good
real
idea.
quick. Decentraland's population of roughly 800,000 registered profiles has already surpassed Las Vegas's population, according to its current CTO. These are people spending millions of dollars to buy digital real estate in this world because they feel that someone's going to come in later and pay them money to do things there. And maybe that'll be true. If you're not living that lifestyle and like really
we get it.
dialed in, just don't even bother. All right, that's all I want to say.
We should start a crypto index. That's actually a good idea.
We did start a crypto index, but it's not open to the public. But I just think any approach like that is better.
Pierce Crosby, we had him on last week. In his 2020 predictions, he spoke about merger mania. I believe that was one of his predictions, right?
Yeah.
Look at this chart. Whew.
It's a beaut. This is last year double any other year on record.
I mean,
what were the transactions though? Do you even know? Can you think of any of them?
Not off the top of my head. Listen, there's only 3,644. Don't put me on the spot. We have one that was announced this week. Take-Two Interactive is buying Zynga for $12 billion, which, by the way, has been one of the absolute biggest pile of junk stocks that we've seen in quite some time. This thing came public, I think it was 2012. Let's throw up this chart.
Zynga?
Oof. Yeah, Zynga.
But nobody ever made any money.
We don't get rid of this.
This is not it.
It's down 7% from the IPO. So it did, in fairness, it just went on an epic run. Like,
there was a crop of these early social media. Zynga's gaming, but it's social gaming, and it's very involved with Facebook. There was a crop of these early social media IPOs. In 2011 was LinkedIn. 2012 was Facebook and Zynga. Like almost none of them ended up being great stocks. LinkedIn got acquired, of course.
Remember Yelp? Oof. Gross.
Almost none of these things made for good investments. And Zynga, people don't realize. First of all, all the founders became built. No, that's King.
No,
that's King Digital. Yes, it is. Dude, don't fuck with me. That's a company called King, based in Britain. Was the maker of Candy Crush.
So what did Zynga do? Oh, does it do Farmville?
farm ass, whatever. Another fucking waste of time. But all of the people involved became billionaires and are still to this day influential, like in the world of tech, even though no shareholders made any money as a result of this. Like, they're all still dining out on this. I was a founder of Zynga bullshit.
Was Farmville the metaverse?
Farmville was an early version of the metaverse. Very good. Very good, Michael. Do you think there would be more mergers this year? I don't think you need rates going down or staying down. I think there are plenty of years where rates were rising, where there's tons of M&A. I just think it's like an industry by industry thing. So I think we'll probably see more.
Ben and I were debating this. Who gets bought first, if either? Like a Robinhood or Peloton?
I can't believe Robinhood's not acquired already.
The thing is, I think there's a lot of negative brand there that companies.
With all due respect,
hold on.
Do you think Goldman's afraid of that?
Yes. When Disney didn't buy Twitter because of the toxicity, I think it's the exact same deal.
So I don't, because with Twitter, the toxicity is the product. With Robinhood, there happens to have been a scandal that seems to have already been paid for, and they're not selling toxicity.
No,
they're basically.
I'm not accusing them of that, by the way.
Twitter is selling toxicity. That is what they're selling. Engagement, which is another word for people literally getting to the edge of almost killing somebody else over something that they said.
But Robinhood did over $1 billion in revenue last year.
I think revenue is shrinking though, because a lot of their revenue came from these micro bubbles in GameStop and Dogecoin.
Yeah.
And they haven't found a replacement bubble.
They will.
Maybe everybody on Robinhood gets really into shorting shares of Robinhood. Maybe that becomes the new. That would be very meta. But to me, you're just buying the users. So if you're Goldman or Morgan Stanley, and if you're a firm that just bought E-Trade, why wouldn't you buy Robinhood?
How about this? How much does Zoom have to go down before Google says, "All right, we'll take you"?
They don't need it. That's the thing. It's that. So that was my point before. Like, if they disappeared tomorrow, it wouldn't matter. This isn't like
they have a ton of customers.
Yes, but the switching cost. All right, this is important. The switching cost is zero.
Stop whispering to me.
No.
I feel like you're lecturing me.
They do have a ton of customers, but I am a paying Zoom customer, and somebody was on my calendar, and I just said I clicked Google Meet, and that somebody is a very famous Wall Street person, by the way, and was very happy meeting with me via Google Meet. It didn't matter to him, didn't matter to me, was easy in my calendar app. There's no switching cost at all. And this is the issue. This is the problem. So Peloton should be bought. We talked about that.
Well, I'm asking. Yeah, that's the other one.
Somebody should buy that. But maybe they think they could wait and get it for less. What's the rush? So, all right, let's move on. We're gonna do what was this? Wait, what was this thing from the Quarter app? Should we do this first?
Oh no. This is just the combined company of Take-Two and Zynga. Doesn't matter.
All right, Duncan, come on in, my friend. Where are you?
There he is.
Guy.
Hey, guys.
Miss that face. It's been too long.
Yeah, it's been
quite
like 30 minutes.
We haven't seen Duncan in person in a long time. We're seeing him Thursday.
Right. Yeah.
Do you get upset when I whisper to you? Is that just Mike?
No, I like it because the level was
condescending.
Was really
Don't
good.
Whisper.
So
I appreciate that.
I told everyone in the chat, since Mike checked, Michael backed away from his mic and you got closer to your mic. And so we just have this like seesaw of levels.
How's my levels?
You could get closer. Okay. So first up today, we have a question.
I love the standing though. Does this work for the show? Can I keep doing this?
No, it works. Yeah. And
Look how much room I have for activities.
People are super impressed that you're standing up.
Look at the range that I have.
It's true. You can just move around. Yeah, I can't do the standing desk. I don't know. I'm a person that wants to sit when I'm on my computer.
I don't own a chair. I never sit.
All right, 6:15. 6:15. Let's go. What do we got?
Okay. So first up, we have a question from Jeff who writes, should I move part of my 40% bond allocation from a total bond fund and stable bond fund to Stablecoins? If so, how much?
All right. Hold on. Okay, fine. Why not?
What do you own the bond fund? No, what do you own the bond fund for?
You talking to me?
No, like rhetorically, what does one own a bond fund for right now?
Stability and liquidity.
You're gonna get that definitely from a stable coin. The way
okay,
that you'll get it from a bond.
Did Jeff ask if he should move all of his money?
That's a good point. But he did ask if he should move some of his money.
Right.
Is that Kobe? Oh, it's Logan.
No, I'm not done.
Oh. All right.
Hold on. Okay.
Look at that little stable coin.
Here's why. 8 to 8.5%. And here's how I think about stablecoins and the risk therein. To me, the real risk, I don't give a crap if it goes from 8.5% down to 6%. That's not risk. Risk is you get wiped out. So how do you price that? You can't. So here's how I would think about it. Think about like you're underwriting, oh my God, investing in like a single B bond, for example. How much money would you put into a single issuer? And if you frame it like that, that is probably a good way with which to look at these investments. So can you put some money in? I mean, obviously, listen, this is your particular risk appetite, but I have money in these products. And my thinking is if they go to zero, I would be seriously pissed. Obviously, but it's a risk that I am going in wide-eyed.
So are you saying to buy multiple stable coins and not just one? Because it's like a bond issuer?
Like I can't because I'm in the state of New York, so my options are limited.
What stable coin do you own?
I'm in GUSD, earning 8.5%.
Is that Grayscale?
It's Gemini.
Gemini stable coin.
Yeah.
Okay. All right. And that's paying you 8.5% annually. How often are you getting that? How often are you getting the yield from that?
Daily, son.
You're getting daily yield from that?
Yes.
Okay. Do they make disclosures about what is inside of that to generate? I know it's staking and blah, blah, blah.
Yes, but good luck. Yeah.
Because so a normal person wouldn't even understand it no matter what anyway.
Yeah.
Exactly. That's why it's 8.5%. Okay. So you're you're getting way more yield than you would get in a bond fund. And what you're accepting in return for that is a fucking rug pull of the century that is undoubtedly coming at some point this year, probably when Congress...
You have no idea what you're talking about.
Probably when Congress tells the SEC, put an end to that nonsense immediately.
Okay. So here's how I think about it, is I'm getting 8 times the yield, roughly. Not 8
You're
as
taking
much
like
anymore.
3 times the risk.
Let's say I'm taking 7 times as much risk.
Yeah, I get it.
As a treasury.
I get it.
Is it 7 times as risky as a treasury? It might be 100 times more risky. We'll find out.
Last 2 questions. Are they paying that out in the form of more stablecoin, or are they paying USD?
Yes, but I can convert that immediately. Anyway, next question, which is probably also crypto related.
That would be funny if they paid it out in USD.
There are gold miners that people own because they want out of US dollars, and the gold miners pay a dividend in dollars. It must be bittersweet to be a holder of the gold mining stock. Damn it, stop giving me these dollars I'm trying to get rid of.
All right,
what do
next
you got?
question.
Okay, next up, yes, another crypto question. So Kendall writes, I got into crypto during the COVID crash, and I've had some great gains since then. Some of my trades were Bitcoin at 8,500, Ethereum at 1,300, nice. Solana at $70, etc. However, I started with 10% portfolio allocation in crypto, which grew to 20%, and I didn't change it. Then it went from 20 to 30, and I trimmed it back to 20. Then it grew back to 30, and then to 40. Now it's grown to 50% of my portfolio. Should I stick with my plan and trim back my allocation, or let my winners run and only allocate into stocks and bonds from here on out?
This is the tough one. What do you think, Josh?
I think it'll be 20 soon. Just hang out. I'm telling you the truth. I'm telling you the truth.
No.
Death cross in Bitcoin.
You're telling him
this
your
week.
opinion. You're telling him your opinion.
Yeah, my opinion is don't worry. Just hang out.
Answer the question.
I think that all of the gains that you're talking about, 2 things. First, congratulations, they're yours. It's real money. You made that money by taking risk, and it's legit. The longer you let that run, the more chance there is that you lose those unrealized gains, and they become regrets. So the more frequently you can rebalance in things that have gone up 1,000%, the better, because it's unlikely for them to repeat that. Now,
generally, that is good advice.
That would not have been good advice backward looking in Bitcoin and Ethereum. I understand that. That doesn't mean it won't be good advice from today forward.
Well, not necessarily, because even if you rebalanced, if you were in Bitcoin early and you're a diversified investor and it grew to 80% of your portfolio, the downside sucks. right? As it becomes a bigger and bigger piece of your portfolio, you're eating all the downside volatility. So if you rebalance, and Josh is right, and Bitcoin goes or crypto goes a lot lower, the pain will feel less severe. So this is really a risk tolerance thing. So
It's
right now,
isn't it a regret minimization thing more than a risk tolerance thing? Because he is playing with the house's money in that area of his portfolio. So it's more like, what will you be more mad at if it round trips back to where you bought it, or if you rebalance out and it continues higher?
Well, obviously,
you have to ask yourself which you could live with and which you can't.
Well, most people could live with selling and it going higher. Otherwise, if it goes all the way, if you give all the gains back, you're going to feel like a pig. And that sucks. That's a worse feeling, obviously.
So I agree with you. So, but that's not going to be the case for everyone. So,
but here's my point. This is
ahead.
individual advice, because this person knows how they feel today with Bitcoin 45% off the highs or whatever it is. If this makes you sick, then you have way too much crypto, right? If this is keeping you up at night, you have way too much. If you're still sleeping cool, then I would say you're okay. Now,
I think that's right, because Bitcoin is going to Bitcoin.
Yeah.
Like, this is what it does.
Right.
Right. Even though each time it's been cut in half has led to higher highs, I got to be honest, the last higher high was not very much higher than the prior high. Like, let's keep it real. Bitcoin, what was the top before 67,000?
Got it. So it topped
58.
It topped in November at close to 70, and prior to that, in April, the top was only 64. So you're right.
So it doesn't seem like the highs are justifying the volatility the way they used to.
You're right.
But
over the last year, the risk-adjusted returns in Bitcoin have been dog shit. Absolutely terrible. You over the past year, you have not even come close to being compensated for the risk you took.
Right. Duncan's playing us off. Is this the Oscars?
It's like the Oscars.
I just thought of the Curb.
You got somewhere to be?
I just thought of a Curb episode where he starts playing.
Listen, we went 53 minutes tonight. It's enough.
Yeah, no, I thought
more
we were
whispering. If you agree not to whisper, I will agree not to whisper. There's no more whispering.
I appreciate you, Michael. All right, let's wrap up here. Here's what I want to tell you. Tonight's Tuesday night, which means tomorrow morning, in your podcast app will be an all-new episode of the best financial podcast there is Animal Spirits.
Is the Fed Trapped?
The Fed Trapped
That's
is the theme of tomorrow's show. And it's Michael and Ben and all of the stuff that we didn't get to tonight. So make sure you check that out. New Compound and Friends at the end of the week. We appreciate you guys coming to the live tonight. Thank you so much. Make sure you like and subscribe, and we'll see you next Tuesday.
Thank you.